Hello everybody, this is Logan and I hope you are well. I wanted to make this video to discuss the arguments behind both inflation and deflation and present both cases based on two investors and market strategists I both respect, Dr. Michael Burry and Dr. Lacy Hunt. While both of these individuals come to different conclusions, I hope to present both cases to you and allow you to all decide for yourself based on their arguments. So with that being said, I'll explain why I chose Dr. Burry and Dr. Hunt as the two professionals to represent their sides. To begin with, there are many other investors on both the inflation and deflation sides of the debate, such as Peter Schiff, Steve Van Meter, Jim Rickards, Harry Dent, and many more. But I chose Michael Burry and Lacy Hunt for several reasons. First of all, they both have an amazing track record. For Burry, it has been correctly identifying the past three major market bubbles which have happened, starting with the dot-com bubble, the housing bubble, and the bubble prior to COVID. And in each of these circumstances, Dr. Burry was able to correctly identify the best way to position himself to benefit from the popping of these major bubbles. So needless to say, Michael Burry has one of the most solid track records out there on the inflation side of the debate. Dr. Lacy Hunt also has a stellar track record. Dr. Hunt is currently the Executive Vice President of Hoisington Investment Management Company, but prior to this he has also been the Chief U.S. Economist for HSBC Group for 14 years. Prior to that, he was the Executive Vice President and Chief Economist at Fidelity and Senior Economist for the Federal Reserve Bank of Dallas. So needless to say, Lacy Hunt has a stellar track record when it comes to understanding demographics, debt, and the banking system as a whole. So I'll first jump into the commonalities both of these individuals have within their arguments. Firstly, they both believe that eventually inflation will be much higher than it is now. However, the timeline for this inflation is different, and this is an important distinction. If, for example, you believe deflation is coming first, you would not want to hold as many assets during this period when the dollar's purchasing power actually increases temporarily. So if you believe deflation's happening, you would want to sell assets, acquire dollars, and then buy back assets when they are cheaper relative to the dollar. If, however, you believe inflation is only accelerating from here, you would want to get out of the dollar and into whatever assets you believe would perform the best against the demise of the dollar and other fiat currencies. So even though Dr. Burry and Dr. Hunt agree that eventually inflation will get out of control, there is an important distinction between temporary deflation and immediately accelerating inflation. Let's first examine the deflationary side of the argument, as it is often the less understood and less intuitive side with Dr. Hunt's key points. Firstly, the road to deflation takes a long time, and this has started since the detachment of the dollar from the gold standard, and ever since then debt has gradually increased more and more, until now we have an enormous debt to GDP ratio well over 100% in the United States. The most important thing to understand about debt is that debt is an exchange of future growth and future profits for current spending. So when you take on debt, you are exchanging future growth and future profits you could have had in order to spend that money right now. And there is no way to get around this. As you will see, and as should be obvious, you cannot get something for nothing, and there is no exception for this rule. Furthermore, according to Dr. Hunt, debt must be used very judiciously and effectively and in a limited manner in order to be effective. And modern debt policies have definitely grown past that point. I'm pretty sure we can all agree about that. So if you become heavily indebted, you cannot print your way out of a bubble. So in other words, when you reach a certain point of financing economic activity with more debt, you eventually reach a point at which it has diminishing returns and then negative returns on the economy. For example, the consumer savings rate is currently historically lower than the average of 8.5%, but the combination of weak income growth and having heavy spending suggests that this cannot go on. Consumer debt is likely the most disturbing fact, as credit card debt, student loan debt, margin trading debt, and other debt are still close to or at all-time highs. So essentially, when you have a debt crisis like we do now, you can either go on to become like Japan, which since 1990 has had one heroic government bailout after another, or more historically probable is that the debt bubble defaults and implodes on itself. And classic examples of this would be the crash of 1929, right before the Great Depression, or the crash that occurred between 1873 and 1893, the period of the railroad boom and bust, and countless other examples of period of debt default. So it is much more likely that eventually taking on more debt cannot solve indebtedness. In fact, it's possible that this goes on to eventually happen to Japan and other immensely indebted nations. It's just a question of when the line has been pushed too far. And as Warren Buffett has stated when asked, whether QE and whether it could continue forever, he essentially said if this monetary policy worked, it would have been discovered 2,000 years ago. So essentially, there is no sort of new idea of monetary policy that has not already been tried. And Dr. Hunt points out historical patterns between growing indebtedness and worsening demographics. In other words, when you have savings rates fall, people can spend more and live more on the edge, living paycheck to paycheck. And when consumers are in this position of extreme spending, birth rates fall significantly. Japan, again, is another great example of this compounding problem. During the 1950s and 1960s, Japanese families were on average having more children than U.S. families, and this was seen as an extremely bullish pattern if it could continue. However, this did not continue, and at this point in 2021, you now have more diapers sold in Japan for seniors and adults than for babies. So Japan by far has the worst demographics than any other industrialized nation, but the United States, Canada, Greece, and other European countries are heading this direction as well, with falling birth rates. Another major point Lacy Hunt points out is that of the money multiplier and the effect heavy debt levels influence the money multiplier. And essentially, when you have an increase in debt leading to decreased savings, the money multiplier goes down dramatically due to less and less spending on goods and services and more spending simply on servicing the debt. So long term, this fall in the money multiplier causes disinflation or decreasing rates of inflation. And if this goes on long enough, this eventually leads to deflation, where you have an increase in the purchasing power of the dollar due to this extreme fall in consumer spending due to servicing the enormous debt load consumers carry. So this, in a nutshell, is Dr. Lacy Hunt's major points of arguing for deflation. Growing debt leads to decreased spending, which also decreases the money multiplier, and this compounds on itself until you have deflation, not inflation. Now getting onto the inflation side of the argument and Michael Burry's argument. And a little side note is that inflation is definitely the most commonly held belief out there right now among both experts and retail traders, because it is definitely the most intuitive. But without further ado, here are Dr. Burry's major points. Ever since modern governments have been able to bail out companies and ward off deflationary depressions, they have successfully perpetuated this through several cyclical downturns over at least the last 20 years. So you have the dot-com bubble bursting in 2000, which would have sunk several major hedge funds and banks, and the government stepped in and took on this moral hazard and bailed them out for a total of several $100 billion. Then along comes the housing bubble, which officially burst in 2008, and this time the government stepped in, bailing out many major banks as well as expanding welfare programs to aid consumers. And in doing this, the moral hazard and total bill was roughly an order of magnitude greater, now costing a total of several $1 trillion. Then along comes the everything bubble of stocks, housing, student debt, etc., which burst when the COVID shutdowns hit, and the government stepped in, bailing out companies right and left whether they really needed it or not, and bailing out consumers with direct stimulus payments. And the total bill of all this spending has yet to be seen, but it is probably going to be somewhere around $10 trillion. So again, another order of magnitude of debt added and moral hazard taken on. So getting on to Dr. Burry's main points drawing from these statistics are, first of all, by postponing the actual defaulting of this debt, the problem of growing debt has only gotten worse, and it has gotten worse in a spectacularly big way. Because of this, if the government can continue perpetuating this bubble, they will definitely try to do so, if it begins imploding again. This time with even more money than we have ever seen before, so this would likely mean in the tens of trillions of dollars of liquidity being pumped into assets, company balance sheets, and directly to consumers again. So when you have this level of monetary supply expansion, or should I say explosion, even if the monetary multiplier goes down significantly, inflation would likely get out of control very quickly, and even hyperinflation would not be out of the question, as Dr. Burry has alluded to. So these are the essential nuts and bolts of Dr. Burry's argument. Government bailouts lead to dramatic increases in the monetary supply, which eventually needs to lead to higher inflation. Now, looking at Michael Burry's portfolio, it appears he does in fact believe this is coming soon, as several of his positions reflect this. Firstly, he has a major short position in Tesla, which likely could face massive downward pressure on its valuation should nominal interest rates rise due to inflation. Also, Michael Burry has direct bets on bond prices falling, as well as interest rates rising, which further reflect his conviction in this outcome, so Dr. Burry's money is definitely where his mouth is right now. Now, this video is to summarize the key points behind the deflationary downturn and inflationary downturn debate, as well as to point out the commonalities these experts have with each other. Again, the decision is up to you, which kind of downturn ends up happening, and we'll definitely have to see, but it does appear all these experts do agree that some kind of downturn is coming, so that is definitely important to note. If you liked this video and you want to hear more informational videos regarding investing and questioning the crowd thinking mentality within the markets, then consider subscribing to this channel.